Financial markets explained. Today, let's simplify the world of financial markets and understand why they matter to you. Most people think financial markets are only for experts, but the truth is, if you're planning your future or saving for a home or building security for your family, you're already connected to the financial system. Think of the financial market as a giant marketplace, not for vegetables or groceries, but for financial assets like shares, bonds, loans, and more. It connects savers with borrowers, helps businesses grow, and supports national development. And every time you participate, even by simply saving money in a bank, you help build India's economy and your own wealth. Let's dive in and unlock the power of financial knowledge together. First, let's understand money markets versus capital markets. India's financial markets form a vast ecosystem with two major components, the money market and the capital market. Both are essential, but they serve different purposes. The money market serves the short-term needs. It deals with short-term borrowing and lending. Anything up to typically 1 year, that is 12 months. Banks, corporations, and financial institutions use it to manage their daily cash. Common instruments include treasury bills, which are also known as T-bills, commercial papers, and certificate of deposits. These are safe, quick, and highly liquid, ideal for managing short-term financial requirements of large volumes. Now let's understand the capital markets. Well, these are for long-term. The capital market focuses on long-term funding for business expansion or infrastructure requirements or other major projects. It is divided into two parts. The primary market, where the securities are issued, like that of the IPOs, and the secondary market, where existing shares are traded, like the two biggest stock exchanges of India presently are NSE and BSE. While the money market ensures smooth daily functioning, the capital market helps individuals and institutions build wealth over time. By understanding both, you can make smarter financial decisions. Now, which are the key institutions behind India's financial markets? Our financial system is protected and regulated by several crucial institutions. First, the Reserve Bank of India. It manages currency, controls inflation, and ensures banks operate safely. Next comes the SEBI, or the Securities and Exchange Board of India. It protects investors and ensures fair, transparent functioning of capital markets. And then the stock exchanges, NSE, BSE. These are primary stock exchanges where trading happens daily. Other than that, we have the banks, the NBFCs, which are non-banking financial corporations, mutual fund houses, and stockbrokers. They connect you directly to these markets and help you invest easily. Thanks to this robust system, you can invest with confidence. Now, how financial markets touch your daily life? Even if you've never bought a single stock, financial markets influence your everyday life. How? When you shop or make online payments, when you save money in a bank, when you take a loan, when your EPF grows each year, EPF as in the Employees Provident Fund, or when you buy insurance. All these are determined by interest rates, loan EMIs, returns on savings, and even the value of your retirement funds. These are all shaped by market activity. A portion of your EPF is invested in government bonds and equities to help your savings grow. Mutual funds allow you to invest in diversified portfolio without needing deep expertise. Insurance companies invest your premiums in safe assets so that they can protect you when needed. Everyday actions connect you to a powerful financial network that works in the background, helping you save, invest, and secure your future. Is the stock market gambling? Well, here's the truth. Many people still think that the stock market is gambling. Actually, it isn't. When you invest, you're not betting. You're becoming a part owner of a real business. Your returns depend on the growth and performance of those businesses where you invest. You don't need to be rich. You don't need to track prices all day. You don't need to be an expert. With mutual funds, SIPs, and modern platforms, anyone can start small and grow steadily. Yes, risk exists, but it can be managed by diversifying across companies and sectors. Remember, it's time in the market, not timing the market, that creates wealth. Investing is about patience and discipline, not luck. 5 essentials every Indian investor should know. If you're ready to begin your investment journey, keep these fundamentals in mind. Number 1, learn the basics. Stocks make you a part owner of a company. Bonds are loans you give to companies or the government against interest. Mutual funds pool money from many investors, big or small, and invest in multiple diversified investments. Understand SEBI and investor protection. SEBI, or the Securities and Exchange Board of India, ensures transparency, regulates brokers and all other players in the stock market, and safeguards your interests, you as in the investors' interests. Know how IPOs work. IPOs allow you to invest in companies going public for the first time. These are often early stage opportunities. If you study them well, these are hidden wealth creators. Open a demat and trading account. This is your digital wallet and platform for stock transactions. You may choose discount brokers like Zerodha for low fees, full service brokers like HDFC for research and expert guidance. And most importantly, trust the power of compounding. Your returns create exponential growth, and that is what compounding is all about. Start small, invest regularly through SIPs, stay consistent, and let time do the magic. The final word: investing is not a sprint, it's a marathon. Success comes to those who stay committed and keep learning. Your journey towards financial freedom starts today. Take the first step with confidence and a long-term vision.